very baked in. It's foreshadowed by the central bank, and it's ahead of the curve doing this because it can afford to do so, right? The economic cycle is definitely on the upturn. Exports are roaring thanks to strong demand of chips and also ships by the US and also globally in China, Japan, across the world. People want more semiconductor. Not only that, not to mention the fact that South Korea never really had lockdown. And if you look at Google Mobility, it's largely normalized, if not growing from the baseline, particularly if the move from pandemic to endemic, given high vaccination rates. So South Korea's got two engines going, exports and also domestic demand. If you look at the retail sales, very, very, very strong. Now, the central bank is not only confident about growth, which is likely to be above 4% this year, but it is also worried about excess liquidity, the support that it gave during the pandemic, fueling the leverage of households. If you look at household debt as a share of GDP of South Korea, it's increased quite substantially, above 100% of GDP now. And so the rate hikes are also doing that part to not just to temper inflation because of strong growth, but also to slow down this excess growth of leverage. And that too is to ensure financial stability. And we see that given the expectations of higher rates by the US and the hawkish minutes that you saw by the Fed, this is a right move, not just for South Korea, but also to synchronize with the Fed cycle.
Okay, so the rate move on two counts for the domestic economy, as well as to keep it in sync with what the Fed is likely to do now, which is get more aggressive, and it's being forced to play catch up. So domestic conditions first, Trinh, if we could. My question to you is, this move up to 1% baked in, is it enough to put the collar around household debt in South Korea, which has long been a bit of a problem here? I mean, the numbers have been coming off, I know, but mortgage lending, that is still proceeding, is it not?
Right. I mean, it's working a bit. You saw of course, the level continues to increase, but the growth rate in the latest release has tapered. And I think with this rate cut, it would taper further because the rise of interest rates will, put a cap on demand. It also has an impact on not just leverage of the household, but also financial markets, right? To create more two-way volatility, because let's not forget, before Korea went as far as stopping short selling of its stocks. So now it's basically withdrawing a lot of that support to ensure financial stability. So there can be a little bit of a short-term pain, but it's going to ensure much more sustainable growth in the future. And it can afford to do so because it has two engines going. Now, the big question mark is not what it did today, but how much more will it do next year, because there is softening of the external demand.
Exactly.
You already saw that prices are softening. And also, given what I mentioned, not just high leverage of the household, but increasingly higher leverage of public debt, which is still below OECD average, but it's risen quite a lot during President Moon's term, thanks to the expansion of the fiscal.
Trinh.
So I think there's a limit to how much it can raise as well next year.